Welcome to the Opening Bell Report.
If you're listening to this right now, you already know that navigating the stock market requires cutting through just an endless mountain of noise.
Oh, absolutely. It's constant.
Right. Every day there's a new headline, a new panic, maybe a new hype cycle. But today, we're going to bypass all of that for you.
Yeah, we're tuning out the daily chatter.
Exactly. Welcome to this deep dive where we take the raw data and distill it down to what actually matters. And today, well, we are looking at a company that has, quite frankly, been defying financial gravity.
That's probably the best way to put it, yeah.
We're talking about Palantir Technologies, Inc.,
Yeah.
ticker symbol PLTR. And let's just set the scene for you really quickly. It is March 2026.
Right.
And if you've been watching the charts, you know Palantir stock has been on this wild parabolic ride. I mean, it recently hit a 52-week high of $207.52.
A massive run-up.
Massive. But over the last few weeks, it's seen a heavy pullback. It's currently trading in the mid-140s.
Which is a pretty significant haircut.
It is. But here's the thing that makes this deep dive so critical right now. While the stock price is, taking a breather and the momentum traders are rushing for the exit.
Looking for the next shiny thing.
Exactly. The underlying financial engine of this company is doing something completely unprecedented. Palantir just did the impossible, and that's the focus of our deep dive today, their massive profitability.
It really is a fascinating divergence between the stock's short-term price action and the actual business mechanics. And the mission of our deep dive today is to completely strip away that daily market sentiment. We're going to look strictly at the raw, unfiltered Q4 2025 financial data from the analysis report we've gathered.
Because the numbers don't lie.
Right. We want to understand exactly how Palantir achieved profitability metrics that, historically speaking, shouldn't even be mathematically possible in the software sector.
Yeah, the math is wild on this one.
It is, because right now, Wall Street is fundamentally divided into two distinct, highly vocal camps.
The lovers and the haters.
Exactly. On one side, you have analysts and institutional investors who are absolutely mesmerized by Palantir's flawless execution.
Right.
And on the other side, you have people who are genuinely terrified by the company's sky-high valuation multiples.
Which is fair, honestly.
It is.
Yeah.
So my goal today is to break down exactly why both sides feel the way they do, relying entirely on the hard data from the report.
Okay, let's unpack this historical baggage first, because, you really cannot appreciate where Palantir is today without remembering the massive cloud of doubt they operated under for years.
Oh, the narrative was incredibly stubborn.
Right. For the longest time, the prevailing bear argument, the narrative that kept a lot of major funds away, was that Palantir was just a glorified IT consulting firm for the CIA.
The spy software label.
Exactly. The critics claimed they were this defense-reliant contractor that built highly customized, clunky software that basically required armies of forward-deployed engineers to operate.
Unscalable, basically.
Unscalable. The running joke in Silicon Valley was always that they could never scale commercially, and more importantly, that they would never achieve profitability.
Right. They were entirely boxed in to this defense-only corner.
So looking at our research, how did they manage to escape that box?
What's fascinating here is how violently that narrative has flipped.
It wasn't a slow transition.
Not at all. And the catalyst for this transformation wasn't some clever marketing rebrand. It was a fundamental shift in their product architecture with their artificial intelligence platform.
AOP.
Yes, AIP. And this wasn't just a gradual shift into the commercial sector. I mean, AMP has caused an absolute explosion in enterprise adoption.
It's everywhere now.
They moved from being perceived as a niche, secretive defense contractor to basically building the core operating systems for the modern enterprise.
Which is a totally different ballgame.
Exactly. Think about what AIP actually does. It doesn't just give a company a fancy chatbot.
Right, it's not just generating text.
No. It integrates a company's disparate data silos, supply chain, manufacturing, human resources, logistics, and it creates a real-time ontology.
A unified view of everything.
Yes, and it allows the AI to make physical, operational decisions.
Right, so instead of just, analyzing past data, it's actively deciding which factory to reroute parts to when a storm hits.
Exactly that.
That sounds great in theory, but I want to look at the actual adoption. I know the commercial revenue numbers have been accelerating, but I need you to translate the latest data for me. Just how big was this pivot in the fourth quarter?
It was nothing short of historic. Looking at the Q4 2025 data, their U.S. commercial revenue hit an incredible $507 million in a single quarter.
Wow.
And that represents a 137% year-over-year surge.
Oh, wait, 137%?
137.
Put that in perspective for you listening.
Yeah.
If a normal software company grows their commercial business at 20 or 25%,
They're thrilled.
their executives are popping champagne, they are high-fiving in the boardroom. Palantir is growing a mature commercial sector by triple digits.
It's practically unheard of.
That is not a pivot. That is a hostile takeover of a completely new market.
And if we connect this to the bigger picture, this is the ultimate case study in what a successful business transformation actually looks like.
Without a doubt.
The U.S. commercial sector now makes up the vast majority of Palantir's overall growth. It has utterly destroyed that old defense-only narrative we talked about.
It's completely dead.
Right. When you evaluate any business that's attempting to change its core market, this level of rapid scaled adoption is the gold standard. They didn't just enter the commercial space, they are dominating it.
So the U.S. commercial side is booming. But I want to know how that translates to the overall quarter.
Yeah.
Because, one division doing well is great, but it doesn't always lift the whole ship.
Sure.
What did the broader Q4 macro numbers actually look like?
Well, the top-line numbers completely crushed consensus expectations. Total revenue for Q4 hit $1.407 billion.
$1.4 billion.
Right. That is a 70% year-over-year increase across the entire business.
Across both defense and commercial.
Exactly. Which marks their highest revenue growth rate ever as a public company.
Wow.
And on the bottom line, their diluted adjusted EPS or earnings per share came in at 25 cents, which easily beat analyst estimates.
Okay, a 70% growth rate on a $1 billion+ baseline is massive.
It's massive scale.
But usually when you see a software company growing that fast, they are burning cash like it's going out of style.
They're spending everything they make.
Right. They're spending millions on customer acquisition, aggressive marketing, heavy hiring. Are they actually keeping any of this money, or is it all going out the door to fund the growth?
That is where the true anomaly lies in these numbers.
Okay.
Let's break down the margins, because this is what has Wall Street so divided. Palantir posted a net income under strict generally accepted accounting principles of $609 million.
For the quarter.
That represents a staggering 43% margin.
That is a lot of cash.
And if we look at their adjusted operating income, it hit $798 million.
Oh my goodness.
That is a 57% margin, up from 50% for the full year. To see a company growing total revenue at 70% while simultaneously expanding its adjusted operating margins to nearly 60%,
It just doesn't happen.
it is incredibly rare.
I want to pause on that for a second because I noticed something else in our research. I was looking at their outstanding shares, and there are roughly 2.4 billion shares floating out there.
Right, the share count.
Yeah, and I know Palantir has a history of stock-based compensation. Should retail investors be sweating over share dilution eating into their slice of this growing pie?
It's a valid concern, and share dilution does remain a minor headwind.
Okay.
However, it is a very minor headwind precisely because of the sheer scale of another metric in the report, total contract value, or TCV.
Okay, let's talk about TCV.
Palantir's TCV skyrocketed to $4.26 billion in Q4.
$4.26 billion in future contracts.
Yes, that is a 138% year-over-year increase. TCV is crucial to understand because it guarantees future revenue pipelines.
It's locked in.
Exactly. It tells us that Q4 wasn't a fluke driven by a few lucky one-off deals. A $4.26 billion pipeline means the demand for their artificial intelligence platform is contracted and locked in.
So the growth outpaces the dilution.
The business is outgrowing the dilution by a massive magnitude.
Okay, so the growth is locked in and the margins are expanding. Let's talk about this rule of 40 concept from the analysis report.
Ah, yes. The golden rule.
I hear this thrown around a lot in the tech sector, specifically for software as a service businesses. Walk us through why this specific metric is the ultimate litmus test and why it matters so much here.
So in the software industry, the business model usually dictates that hypergrowth comes at the cost of massive cash burn.
Like we were just saying.
Right. Companies spend heavily to acquire customers today, hoping to retain them and turn a profit years down the line.
The classic SaaS playbook.
Exactly. Because of this dynamic, analysts use the rule of 40 to evaluate whether a company is balancing its growth and its cash burn responsibly.
How does the math work?
The formula is straightforward. You take the company's revenue growth rate and add its profit margin.
Okay.
If that combined number hits 40%, the company is considered elite. It means they are a healthy, sustainable business.
So hitting 40% makes you elite. What was Palantir's score in Q4?
Their rule of 40 score hit an unbelievable 127%.
Hold on. 127%.
About 127.
How is that even mathematically possible? I need you to break that math down because that sounds like a typo in the report.
It sounds like a typo, but it is real. They achieved that 70% top-line revenue growth, and they dropped 57% of that to the bottom line as adjusted operating margin.
70 plus 57.
Gives you 127%. They didn't just beat the gold standard of the software industry, they shattered it by more than triple.
I need a point of comparison here because a number like 127% in a vacuum is hard to visualize. How does this compare to other elite tech companies out there? Are their peers doing anything even close to this?
This raises an important question, and the data provides a great benchmark. Let's look at another major, highly respected software player, Snowflake.
Okay, great company.
Snowflake is a lead peer in the data space, and they are an incredible company. But historically, they hover around a 20% to 30% free cash flow margin.
Which is standard.
Right. And recently, they've been dealing with slowing top-line growth as the market matures. In stark contrast, Palantir generated a 56% adjusted free cash flow margin in a single quarter,
56% free cash flow.
pulling in $791 million in pure, unadulterated cash.
So when you put them side by side, Palantir is generating cash at double the efficiency of a massive respected peer like Snowflake,
Yeah.
while simultaneously growing more than twice as fast. They have completely decoupled hypergrowth from cash burn.
They really have.
They are proving that you don't have to lose hundreds of millions of dollars to capture the enterprise AI market.
They're showing that if your product is sticky enough, and if it provides immediate, measurable return on investment for your clients, you can dominate a sector while running a 56% free cash flow margin.
Here's where it gets really interesting, though, and frankly, where I need to play devil's advocate.
Go for it.
Because listening to this, it sounds perfect, almost too perfect. We have to address the elephant in the room, the price tag.
The valuation.
Yes. Because despite these flawless 127% rule of 40 numbers, you have to pay an absolute premium to own a piece of this company. I am looking at the valuation as of March 2026, and the numbers are dizzying. What are the exact multiples the market is putting on this right now?
The valuation is where the terror comes in for traditional investors. Currently, Palantir has a market capitalization of roughly $347 billion.
Huge.
Their price to earnings, or PE ratio, is sitting at around 216x. And their price to sales, or PS ratio, is about 77x.
77 times sales.
Those are some of the highest multiples in the entire market.
Wait, 216 times earnings? Even with 137% commercial growth, isn't that just a bubble waiting to pop?
A lot of people think so.
How can anyone, let alone institutional money, justify paying 216 times what a company makes today? If the market sneezes, a multiple like that usually gets cut in half. Are investors just drinking the Kool-Aid here?
It is entirely rational to have that reaction. A 216x PE ratio is designed to scare off traditional value investors. But to understand why institutions are still buying, you have to understand the mechanics of multiple compression.
Break that down for us.
Think of it like buying a really expensive, oversized suit for a teenager.
Okay.
If you look at the suit today, it looks ridiculous. It is way too big. But if that teenager is growing 6 inches a year, they are going to fit perfectly into that suit by next year. That is what Palantir's earnings are doing to this massive valuation.
So because the profits are growing so violently, they're essentially shrinking the ratio from underneath.
Precisely. Remember that $4.26 billion in total contract value we discussed?
Right, the locked-in pipeline.
That guarantees a massive influx of future revenue. So while paying 216 times today's earnings feels astronomically expensive, the business is scaling its profitability so rapidly that if you look 2 years down the line, today's stock price actually starts to look much cheaper relative to their future earnings.
Ah, I see.
The market isn't paying for the present snapshot, they are paying for the locked-in high-margin future.
Okay, the oversized suit analogy makes sense. They're growing into the valuation rapidly. And I guess it is a lot easier for an investor to stomach that premium price tag when you look at their bank account.
Which is massive.
I was scanning their balance sheet in the report, and it looks like a fortress.
Yeah.
Just how much runway do they have to weather any potential macroeconomic storms?
It is the ultimate financial safety net. Palantir is currently sitting on $7.2 billion in cash, cash equivalents, and short-term treasuries.
$7.2 billion in liquid cash.
And the most crucial detail, they have zero long-term debt. None.
Zero.
In the volatile world of tech, where companies routinely carry billions in debt to fund their operations, having $7.2 billion in cash and zero debt obligations is an absolute luxury.
I have to imagine their chief financial officer sleeps better than anyone else in Silicon Valley.
Probably.
$7.2 billion in cash means they aren't at the mercy of interest rate hikes. They don't have to worry about refinancing debt. If a competitor emerges, they can just buy them. If the economy tanks, they can coast for years.
It provides absolute operational freedom, and management clearly feels confident in that freedom based on the forecasts they just issued.
What are they projecting?
They released their guidance for the full year of 2026, and they are expecting roughly $7.19 billion in total revenue.
For the year?
Yes, that represents a 61% year-over-year growth rate for the whole year. And within that, they expect their U.S. commercial business to grow by at least 115%.
Another year of triple-digit commercial growth.
They are signaling to the street that the momentum from Q4 2025 is not a peak, it is the new baseline.
So the business fundamentals are practically glowing in the dark. They have endless cash, zero debt, and triple-digit growth. But how is the actual stock chart reacting to all this perfection? Because as we mentioned at the top, the stock has pulled back from 207 down to the mid-140s.
Right.
What is the technical setup looking like right now?
Technically speaking, the stock is in a necessary corrective phase. After a parabolic run up to 207.52 in late 2025, a cool down was inevitable.
You can't just go up forever.
Exactly. The stock has been consolidating under its moving averages. Recently, it tested the $128 to $130 level as a hard support floor.
Did it hold?
The good news for bulls is that the support held, and the stock successfully bounced back into the 140s.
Okay, that's a positive sign.
But looking at the chart structure, the stock needs a sustained break above the $160 resistance level to shift back into a confirmed undeniable bull trend.
And what are the analysts saying about this setup? With the fundamentals and the technicals colliding like this, where is Wall Street consensus landing?
The consensus rating among analysts remains a moderate buy or a hold.
Which reflects that divide we talked about earlier.
Exactly. They universally love the fundamental business. You can't argue with 127% on the rule of 40, but they struggle to build financial models that justify the premium valuation.
It breaks the models.
It does. Because of that, consensus price targets currently sit around the $190 to $195 range. However, more bullish institutions, like Citi, have recently updated their models and upgraded their 2026 target all the way to $235.
Wow, 235.
The overarching consensus is that Palantir's fundamental business is arguably the strongest in the enterprise software space right now.
But there is a catch to all of this, isn't there? Because the market doesn't just hand out 77x price-to-sales multiples out of the goodness of its heart.
There is a massive catch, and this is the ultimate takeaway from the data that you, as an investor, need to internalize. The catch is the expectation game.
Perfection is priced in.
At 77 times sales, the market has priced in absolutely zero margin for error. Palantir has proven they can do the impossible, but to maintain this valuation, they must continue doing the impossible every single quarter.
They can't slip up.
Any slight miss in execution, any slowing of that U.S. commercial growth down to, say, 50%, which would be amazing for anyone else, and a premium valuation like that will be heavily, aggressively punished.
So what does this all mean? Let's summarize this deep dive for you. Palantir didn't just have a good quarter in Q4 2025. They completely rewrote the playbook for enterprise software.
They absolutely did.
They took the historical baggage, the idea that they were just unscalable consultants for the government, and buried it under a 137% surge in U.S. commercial growth.
The numbers speak for themselves.
They proved that you can achieve hypergrowth without burning massive piles of cash, hitting an unheard of 127% on the Rule of 40 metric, and dropping 57% of their revenue to the bottom line. They have transformed into an absolute cash-generating machine.
And looking ahead, the next major catalyst for you to keep an eye on will be their Q1 2026 earnings, which are expected to drop in early May 2026.
That's right around the corner.
That will be the first major test to see if they can maintain this flawless execution, defend that multiple, and live up to that massive $7.19 billion full-year guidance.
Mark your calendars for early May, because that earnings call is going to be a blockbuster event.
Before we wrap up, I want to leave you with a final, lingering thought to mull over.
Well, let's hear it.
We have established that Palantir has fundamentally broken the rules of software scaling. They hold a fortress balance sheet of $7.2 billion in cash with absolutely zero long-term debt, and they are generating cash at double the efficiency of their elite peers.
It's an enviable position.
So what happens when a company with this unprecedented level of operational dominance, armed with an endless war chest of capital, decides that building operating systems for software just isn't enough?
What do you mean?
How might they deploy their artificial intelligence platform to reshape entire physical industries next?
That is a fascinating question. If they're already telling supply chains how to route physical trucks, the leap to automating entire physical industries doesn't seem that far off at all.
It's the logical next step.
And it is a story we will definitely be tracking as it unfolds. Thank you for joining us on this deep dive into the latest Palantir numbers. We love being your dedicated research partners, doing the heavy lifting and cutting through the noise so you can understand what is really driving the markets. Stay curious, and we will catch you on the next deep dive.
Don't forget to like, share, and subscribe for more.